Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Janine Yorio of Compound Asset Management. Janine, thank you for joining us.
Of course, thank you for having me.
Great. So what was your background before founding a real estate fintech company?
So my background is in the real estate industry. I was right out of college. I worked for a private equity firm called North Star Capital. And when I started, I was an analyst. I was there for about 8 years. And by the time I left, I was a portfolio manager. And I worked on all different kinds of real estate deals there, many of which we took from origination through to exit, including 5 that we listed as publicly traded REITs. And then I was head of real estate development for Standard Hotels here in New York City. That's the development company that developed the Standard Hotel on the High Line, owned the Chateau Marmont in LA, and the other Standard Hotels in Miami and LA. And so I've enjoyed a pretty varied career in the real estate industry, but it's always been at the intersection of real estate, financial engineering, and consumer brands. And so I think I have a unique perspective to bring to the real estate fintech landscape.
So what's your advice for people that want to get into the real estate fintech space? What would you tell them to look out for?
What's my advice for people that want to get into the real estate fintech space? That would be a very specific ask. And I guess I would advise them to look at all of the companies that have come before them. There was a big wave of crowdfunding companies that were very well capitalized in the kind of 2013 to 2015 era. And so there are a lot of lessons to be learned from what the outcome was of those different startups and the business models that they pursued. But generally, I think my best advice is that it's an enormous sector. It's the world's largest asset class, and there are lots of opportunities to disrupt the category for people who are looking to bring a new perspective to what is otherwise a very entrenched and oftentimes reluctant to change industry.
Well, I saw the crowdfunding world come up, and I saw many of the real estate portals that you alluded to a moment ago come into being, and I think some did pretty well, and I think many did not. And I was curious, what would you think the great takeaways were from that 2015 era when people were going online for this?
I think that generally people loved the idea of crowdfunding and felt that it was the great equalizer, that it was going to bring deal flow to the masses. But as a practical matter, it turned out that it's a very, very slow path to aggregating meaningful assets under management. And it's very expensive to advertise digitally and find retail investors. So I think in general, the space has been a bit disappointing to the investors who have backed those companies. And it didn't prove to be an avenue to raise billions of dollars the way that the investor base had hoped that it would.
So based on those learnings, how do you think the industry is evolving from here? Which direction do you see it going?
I think one of the pitfalls of those companies was that the product wasn't very differentiated. Most of the platforms offered individual deals. They were difficult for the individual investor to try to figure out which transactions were better. It required the end user to do a lot of work on their own to try to figure out which investments to invest in and which to shy away from. And for somebody like me, who spent my entire career evaluating real estate, it was even confusing for me. Like I didn't really understand how to underwrite all the different choices that existed and how to decide, do I want to invest in garden-style apartments in Chattanooga or a grocery-anchored shopping center outside of Tucson? Like it's difficult for me to make a good decision in light of so many choices. And so I think what the real estate industry is missing is truly differentiated product that's really simple and straightforward for investors of all sizes, not just retail investors, but up on through small family offices, pension funds, and endowments to make simpler decisions because investment mandates are clearer and the way that they're going to measure performance is easier to benchmark.
I see. So what is your investment thesis for this sector? Of course, you're talking about making it simpler and making the product differentiated. But in what sector would you actually apply this to inside the real estate space? Of course, it's a very large space. There's residential, commercial, and many different ways to slice it. Where do you think it fits best?
So at Compound, we focus exclusively on the residential real estate sector, which we've defined as a mix of apartments, single-family homes, and in New York City, condominiums. I think that my biggest takeaway is that the vast majority of an investment return in a real estate transaction is based upon the geographic location and the timing, and not the ingenuity of the asset manager or the developer. And the sooner the real estate industry admits that, the easier it will become for investors. And we've seen how in the equity investment world, that's almost considered a truism, where people understand that most of the alpha you generate is relatively small compared to the beta that you get from tracking an index or being a part of a sector that's growing, as opposed to choosing an asset manager who's good at picking stocks. And we're looking to do the same thing with real estate by improving access and exposure to urban residential real estate markets, which have historically performed brilliantly as asset classes.
It appears you're showcasing urban real estate from across the country. Are there any particular cities that are doing better than others?
Well, we are an early stage startup, and so we've only really started working on one product, which is a Manhattan-focused city fund. However, we just published a research report this week about which markets historically in the first quarter of 2019 performed best from an investment standpoint. And by that, we mean which had the highest rate of return coupled with the lowest overall risk profile. And surprisingly, some of the Midwestern markets performed best. I believe Indianapolis was ranked the best performing market from that standpoint. And some of the bottom performers were the markets where that feels more counterintuitive, markets like the California markets, LA and San Francisco.
And why do you think that is so? You think the Midwest is undervalued and coming up to speed, and the East Coast, West Coast is overvalued and overhyped, or what do you think that is?
I think it's a mix of the volatility of those markets, and that the Midwestern markets have performed consistently. They're not the juggernauts that some of the more flashy markets have been. They've been sort of consistent, grinded out performers, and ultimately that's what gives the markets a lower risk profile.
So what are the challenges you face in trying to implement this in the current landscape out there? Is there any regulatory challenges that inhibit what you're trying to do? Is it just the shift of the markets where people are moving from one side of the country to the other, and so timing is a big issue? What is the biggest challenge you have in trying to implement this?
Nothing we're doing requires any special regulatory approval. Everything we're doing is SEC qualified. So in that sense, it's like any other publicly listed company or any other securities business. But from a tax and legal structuring standpoint, the funds we create are taxed and structured as REITs. So we're using a structure that's been around since the 1960s and has been popular since the 1980s to bring this product to market. So there's nothing really uniquely complicated. What's differentiated about our product is how we dissect the market by place, the asset class we're investing in, and the fact that we are intending to issue a family of funds, each of which invests in a specific city.
Right. And what are the risks in those funds itself? What's going to impact the risk profile on it?
So different markets have different risk profiles. So I would tell you that Manhattan as a market is lower risk. Historically, it's performed very well. It's an island, so there's scarcity value. There's historically been a very strong foreign bid, and price support has always been very strong, so that when the market dips, usually dips for a very brief window of time and then immediately starts to improve. Different markets, though, perform differently. And a high flyer like Austin, which has seen a lot of population growth, but has also seen a lot of new development, might actually be a riskier gambit because ultimately Austin doesn't have any geographic barriers to its expansion. I think markets that have underlying geographic barriers have certain lower risk profiles.
So because there's no expansion capability, they have to bid up the value of what's there. They can't just keep growing or sprawling out like they do in Texas. Okay.
Exactly.
Well, great. Well, what else should we cover that we haven't about what you guys do there? I'm sure there's many more things you are doing that we haven't. What else can you tell us?
Well, we are looking to make it simpler for investors of all sizes to invest in high barrier to entry, sophisticated, fast-moving urban markets that have historically been the places where wealthy people have parked capital. And what we're doing is making it more accessible for slightly less wealthy people, foreign investors, hedge funds, pension funds, small family offices that want the liquidity of a public security with the simplicity of a very easy to understand investment mandate.
Great. Well, how best for the listener to get back in touch with you?
So I would suggest visiting our website. The address is getcompound.com, or they can follow us on Twitter at getcompound.
Okay. We'll put both of those in the show notes as well. And looking forward to having you back for a follow-up soon to see how the program is progressing, and appreciate your taking time.
Excellent. Thank you so much. Bye-bye.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.